If you really want to learn how money works in real life, we have to talk about things that usually never show up in school textbooks or polite conversations. No magic formulas, no perfect charts, no fairy tales about turning a few dollars into millions overnight. Just honest experience, the uncomfortable parts included. I did not grow up in a rich family. I did not have wealthy mentors around me. Nobody sat me down and explained how money, debt, assets, and markets really work. Like most people, I grew up surrounded by the idea that you just work, get paid, and somehow it will be enough. It almost never is. The good news is that most wealthy people also started without a roadmap. Wealth is not a talent you are born with. It is a set of habits, rules, and decisions you can learn. For me, money at first was like a Rubik's Cube. I turned it in my hands, tried random moves, watched other people, got frustrated and thought, this thing is impossible. Then I finally saw that there is a system behind it. If you know the sequence, you can solve it over and over again. Wealth works exactly the same way. If you follow certain principles long enough, the outcome becomes almost predictable. Not in a get-rich-this-year way, but in a I will not die broke and stressed way. One of the first painful truths I had to accept was this. There is no perfect moment to start. People love telling themselves stories. I will start saving when my debts are gone. I will invest when the economy is calmer. I will learn about stocks when I have more free time. I told myself the same lies. Then I realized life never gives perfect conditions. There will always be something. Rent, kids, loans, medical bills, travel, emergencies. Waiting for an ideal moment is just a socially acceptable way to postpone your own future. I started thinking in terms of windows of opportunity. Sometimes a new job appears, a business idea, a cheap asset, a market crash, a chance to move to a better city. These windows stay open for a short time. Days, weeks, sometimes hours. If you are not ready with at least some savings, some knowledge, and some free time, the window closes and you stay where you are. My job is to prepare myself in advance. Money in reserve, basic understanding of investing. People I can ask for advice. Then, when a door opens, I can walk through it instead of just watching others. The next shift was learning to think in longer time frames. Most people live in the right now. They want to feel good today, buy today, impress today. Their thinking is one move ahead at best. Wealthy thinking looks more like a chess game. Every financial move from today has a consequence in a year, in 5 years, in 20. When I buy something on impulse, take on a loan, switch a job, start a business, skip saving for the third month in a row, I am not just affecting this week. I am changing my entire future position on the board. There is always a conflict between the present and the future. If I invest more, save more, and pay down debt faster, something in my current lifestyle has to shrink. Maybe fewer restaurant visits, fewer gadgets, a smaller apartment, a cheaper car. It feels like a loss now. But that same sacrifice can become the exact reason I do not panic later when I lose a job or the economy goes crazy. Future me either thanks present me or hates present me. There is no neutral. Debt is where this becomes very obvious. It is incredibly easy today to buy things you cannot actually afford. A car, a phone, new furniture, vacations, clothes. Whether it is a credit card, buy now pay later, or a nice friendly loan from the bank, the principle is the same. I borrow from future me to satisfy today's desires. The bank gets interest. I get the illusion of lifestyle and the reality of stress. There is a huge difference between bad debt and productive debt. Bad debt is anything that takes cash out of my pocket and does not build an asset behind it. High-interest credit cards, personal loans for consumption, most car loans. These things drain me every single month and give nothing back except short-lived pleasure and a used item that loses value. Productive debt is different. That is when I borrow to buy something that reliably generates more cash than the loan costs. An obvious example is buying a rental property in a solid market with a clear plan, where the rent covers the mortgage and leaves a margin. In business, it might be financing equipment or marketing that has a very predictable return. Even with productive debt, I have to be careful. Numbers must work, and the risk must be acceptable. But bad debt is pure poison, especially at double-digit interest rates. Banks are not charities. They are happy to give you an umbrella when the sun is shining and very quick to take it away when it starts to rain. When my finances are weak, a new loan is almost never a solution. It just digs the hole deeper. What I really need then is a change of behavior, not more borrowed money. Before I could even think seriously about investing, I had to fix something more basic: my relationship with money itself. What did I hear about money as a child? That money is always not enough? That rich people are all thieves? That money spoils people? If deep inside I believe that rich equals bad, my brain will sabotage me every time I get closer to real wealth. Why would it let me become someone I was taught to hate? At some point, I realized I cannot treat wealthy people as villains and at the same time hope to join their club. I had to reframe it. Money is not moral or immoral. It is neutral. It makes good people more effective and bad people more dangerous. My job is to stay on the right side of that. Another big factor is the people around me. For a long time, I listened to the wrong voices. Family, friends, colleagues giving confident advice while being constantly broke themselves. Real estate is always a bubble. Stock market is a casino. Only cash is safe. Just take a loan, everyone does. It is not that these people are evil. They simply model what they know. If I copy their map, I get their destination. Today I try to surround myself, at least mentally, with people who are good with money. Books, podcasts, interviews, courses. When I hear someone who has actually built wealth talk about their habits, I pay attention. Then there is emotional spending. I know very well how it feels to walk into a store to buy something small and walk out with a bag full of things I never planned to buy. Or open a shopping app just to check something and realize I burned half a week's budget on stuff that will lie around unused. In those moments, I do not make rational decisions. I am simply soothing stress, boredom, or desire with a purchase. The problem is not the item. The problem is using spending as painkiller. A simple test helped me. Every time I really want to buy something, especially something that is not essential, I try to delay it. 1 day, 3 days, sometimes a week. If after that time I still want it and it still fits my budget and plan, I buy it with a clear head. If the desire disappears, I just saved myself money and future clutter. Delayed spending is like a filter. Impulses die in it. Value passes through. Money itself is not wealth. Cash is just a claim on value. That claim shrinks over time because of inflation. You can see it in any developed country. The cost of food, housing, transport, education, and services creeps up year after year. If I just keep stacking cash, even in a safe savings account, I might feel secure when I look at the balance, but the real power of that money is quietly melting. It is like walking up a down escalator. If I stand still or move too slowly, I still end up lower. That is why assets matter. Assets are things that either grow in value over time or generate cash for me, or both. Shares of strong businesses, broad stock index funds, rental real estate in good locations, stakes in profitable companies, certain types of bonds. A liability, in simple everyday language, is anything that takes money out of my pocket and does not pay me back. A yacht, an expensive car that I barely use, an oversized house that keeps me trapped with taxes and maintenance, gadgets bought on credit because they look cool. There is nothing wrong with enjoying life, but I had to stop lying to myself. My car is not an investment. My vacation is not an asset. They are expenses. Good, enjoyable, sometimes very important for my happiness, but still expenses. One of the most powerful but boring habits I ever built was tracking where my money actually goes. People love to say, "I do not know where it all disappears." That is not magic. That is simply a lack of attention. In business, if you never measure your revenue and costs, the company collapses. Personal finance is the same. When I started writing down what came in and what went out, category by category, I had some unpleasant discoveries. Way too much on random food deliveries. Subscriptions I had forgotten about. Impulse purchases from apps and supermarkets. Micropayments adding up to something that could have been serious savings. I did not build an ideal spreadsheet from day one. I simply began to notice. Each week I would ask myself, do I like where my money went? Which purchases made my life better even a month later, and which I barely remember? That awareness alone started changing my behavior. I unconsciously began to spend less on things that gave me nothing, and more on things that really mattered. From there, I built a simple personal system. Every time money comes in, I already know what will happen to it. A part goes straight to my future. Call it paying myself first. A personal tax for future me. For some people it is 10%. For others it is 20%. The number is less important than the principle. This money goes to savings and investments before I start adapting my lifestyle. Another part goes to safety, building and maintaining an emergency fund, paying for proper health and life insurance if that makes sense in my situation. Only then come the regular life expenses: housing, food, transport, basic needs, kids. After that comes quality of life: restaurants, travel, hobbies, experiences. And only at the very end come big non-necessary purchases like a new car or expensive upgrades. If I reverse that order and start with big toys and lifestyle, my future becomes a hostage. If I stick to this order most of the time, my future gets stronger even when life throws surprises at me. The emergency fund is boring and absolutely critical. It is the opposite of sexy finance. No one posts photos of their emergency fund on social media, but it is exactly what keeps me calm when the company I work for cuts staff or a recession hits. I like to think of it not as a pile of money, but as time. How many months could I cover my basic life if all income stopped? 2 weeks, 1 month, 3 months, half a year. The usual recommendation is to aim at least for 3 to 6 months of essential expenses. For some people with variable income or many dependents, more makes sense. This money lives in very safe, liquid places: insured savings accounts, short-term deposits, maybe a conservative money market fund. Not in risky stocks or crypto. Its job is not to grow fast. Its job is to buy me time and peace of mind. In a global world, many prices are tied in one way or another to major currencies like the dollar or the euro. Even if I am paid in another currency, imported goods, equipment, travel, and even local products often react to those exchange rates. That is why for long-term savings, it can make sense to hold part of the emergency fund or other reserves in a strong foreign currency. Not because I want to speculate on the exact exchange rate, but because I do not want all my safety net tied to the fate of a single currency. The simplest way I have found is not to obsess over every tick in the rate, but to buy small amounts regularly over time. Sometimes I get a better rate, sometimes worse. Over the years it averages out. Now let's talk about investing and markets. One of the most liberating realizations I had is this: nobody knows where the market will go next. Not bloggers, not brokers, not famous gurus, not people on television, not the guy in your group chat. Sometimes someone will make a great prediction twice in a row and look like a genius. Most of the time it is just luck. If I build my strategy on other people's guesses about the next move of the market, I am gambling, not investing. Instead, I try to focus on what is actually under my control. How much of my income I can save and invest. How diversified my portfolio is between different assets and regions. How high my costs and taxes are. How I behave during fear and greed. How consistent I am with my contributions. How much I invest in my own knowledge so I do not panic at every headline. In the beginning of my journey, I also chased big returns. I traded crypto in a bull run, picked speculative stocks, felt like a genius when my account doubled. But my starting capital was small. I could multiply it several times and still end up with an amount that did not change my life. The painful lesson was simple: when your capital is small, The exact percentage return matters less than how much new money you add every month. It is much more powerful to increase your active income and invest consistently than to try to squeeze a few extra points of return through complex strategies. Imagine two versions of me. One spends endless hours trying to find the perfect stock, the perfect timing, the perfect coin. He stresses, trades, consumes endless analysis, and maybe ends up with a return that is a bit higher than average on a small portfolio. The second version focuses on improving skills, changing jobs, building a side business. His portfolio is invested in simple, broad funds that match the overall market, nothing fancy. But because he keeps increasing his income, he can invest much more money in total. After a few years, the second version wins in real dollars, even if his percentage return is slightly lower. That is why I say active income is more important than passive income at the beginning. First, I build the pump that pours water in. Then I care about optimizing the pipes. Markets themselves do not fundamentally change. The technology, the headlines, and the products change, but the psychology does not. When people are scared, they sell. When everything is rising and greed takes over, they rush to buy at the top, feeling late and desperate. Crashes and booms come in cycles. There are always reasons, always explanations, always. This time it is different. But the rules of human behavior stay pretty stable. That is why the famous idea of being greedy when others are fearful and fearful when others are greedy works in principle. The best opportunities appear when headlines scream, "End of the world," when portfolios are bleeding, when it feels insane to buy. In those moments, even I feel fear. It is normal. What helps is to have a plan in advance. For example, if the broad market falls a certain amount from its previous peak, I will invest a certain extra percentage of my cash each month, regardless of how I feel. Not all at once, not trying to catch the exact bottom, just stepping in gradually. When markets recover, which historically they have always done over long periods, those purchases at depressed levels become the most profitable ones in my portfolio. Compounding is real. I know it is fashionable now to say that compounding is a myth, that markets are rigged, that buy and hold does not work because of crises. But when I look at my own long-term results, I see very clearly how reinvested dividends, interest, and regular contributions pile up. The first years feel slow and boring. You save and invest, and the numbers barely move. Then after a while, the growth comes more from the portfolio itself than from your new deposits. That is the moment when compounding starts to feel real. The problem is that most people never get there because they keep interrupting the process. They panic and sell, chase hot tips, trade in and out, pay high fees, use leverage, and blow up their accounts. The math is not the problem. Behavior is the problem. The temptation to cheat the system is very strong. Why wait 10 or 20 years for compounding to work if I can just trade with big leverage, buy complicated derivative products, jump into every new coin or story, and aim to double my money fast? I am not going to pretend I was immune to this. I also tried short-term trading, options, speculative plays. Most of what looks like a shortcut is actually a trap. There is always someone on the other side of those bets. Usually it is a big institution or a professional, not a random person from social media. If my plan to become rich depends on being smarter than full-time professionals in their own game, it is probably a bad plan. So my rule now is simple. I do not try to beat the market by being clever with timing. I do not use complex products I do not fully understand. I do not risk money I cannot afford to see drop dramatically. I focus on owning simple, diversified assets for a long time and adding to them regularly. And I channel my desire for excitement into things that can actually increase my income: skills, projects, business ideas. At some point, I also realized something important about money sitting quietly in the bank. Money only has real value when it is used. When it is frozen just to make me feel safe, it gives me a psychological comfort, but produces nothing. I am not saying keep nothing in cash. I already said the opposite. An emergency fund is key. But beyond that, Hoarding large amounts of cash for years because I am scared to invest is just a different form of fear. Money is a tool to buy time, freedom, experiences, assets, and skills. I can use it to buy other people's time and expertise by paying a team, a consultant, a cleaner, a developer, a designer. I can use it to buy my own time back by delegating tasks I hate, so I can focus on my highest value work or simply on life. I can use it to buy education, courses, coaching, books, conferences that upgrade the only asset no one can take away from me, my mind. I can use it to buy assets that send money back to me, shares, funds, properties, stakes in businesses. Or I can burn it on things that look good on social media and do nothing for my long-term life. With higher income comes another silent enemy, lifestyle creep. When my earnings grow, my brain immediately starts generating reasonable new expenses. Nicer apartment, better car, more expensive restaurants, all the little trending things everyone seems to have this year. Social media amplifies this. There is always a new must-have product, a fashionable experience, everyone is doing it, purchase. Yesterday it was one kind of gadget, today it is another, tomorrow it will be something else. On launch, these things are wildly overpriced because people buy them out of fear of missing out. A year later they are discounted or forgotten. I try to catch myself before I join every trend. I do not want my work and stress to convert into a closet full of clothes I never wear, boxes of gadgets I barely use, or a garage full of toys that impress strangers for a week and then collect dust. When I look around my home, I sometimes play a small game. If I vanished tomorrow and someone else walked in, which things here would they see as useful and valuable, and which would look like pure clutter? That simple thought experiment is humbling. To control impulse buying in a world of one-click purchases, I use a few tricks. I already mentioned the delay rule. Another one is weekly limits. I decide in advance how much I can freely spend this week on non-essential things. Transfer only that to the card I use for daily expenses, and try to make it last until the end of the week. It turns spending into a game with clear boundaries instead of an endless open tap. When the limit is gone, it is gone. I can say yes or no to myself, but the math is honest. There is also one more area that matters to me: investing in myself. Courses, books, therapy, coaching, language learning, professional training, health. These are not investments in the strict financial sense, but they have a massive indirect return. Better skills mean I can earn more and have more options. Better mental health means I make fewer desperate decisions. Better physical health means I can actually enjoy life and work longer without breaking. A business, a property, even cash can be taken away, taxed, or destroyed. But what is deeply integrated into my brain and body is much harder to lose. Crises deserve a separate mention. Economic shocks will happen. Recessions, crashes, pandemics, wars, policy changes, sudden job losses. No one can predict the exact shape of the next one. What I can prepare is my response. An emergency fund in safe form. A portfolio that is not all in one extremely risky asset. Skills that are relevant in different environments. Relationships with people I trust. And the discipline not to make big, irreversible decisions at the peak of panic. In a crisis, doing nothing rash is already a powerful move. Sometimes the best thing to do in chaos is simply to freeze for a moment. Not rush to sell everything. Not rush to buy everything. Not rush to move to the other side of the world overnight. First breathe, think, gather facts, review your plan. Yes, I might miss the absolute bottom or the absolute best price of some asset. But I will also avoid blowing up my future by a move made in shock. Everything I said so far can be compressed into a few simple ideas, but they are worth repeating in human language, not as a checklist. Treat money as a tool, not as a god and not as a monster. Be honest about what is an asset and what is just spending. Avoid bad debt like fire. Use productive debt only when you truly understand the numbers and risks. Pay yourself first and build a safety cushion before trying to look rich. Think in years and decades, not in days. Remember that no one knows the exact path of markets, so build a plan that does not require perfect predictions. Do not try to cheat the system with shortcuts that only look smart. Invest in your own skills and health as aggressively as you can. And protect yourself from your own emotions by having simple rules and systems. I still make mistakes. I still sometimes buy things I do not really need. I still sometimes worry when markets drop and feel a rush when they rise. The difference now is that I have a structure to fall back on. I know why I am saving. I know why I invest. I know what I am willing to risk and what I am not. I know that becoming wealthy is not about one great deal, one lucky trade, or one magical idea. It is about hundreds of small, boring, sensible decisions made again and again. If you got this far, you already have something that many people never develop: patience. Use it. This week you do not need to transform your entire financial life. You can make one small move. Track your spending for a few days. Set up a tiny automatic transfer to a savings account. Pay off a little extra on a bad loan. Read one good chapter on investing instead of watching another prediction video. These steps may look insignificant. Over time, they become the difference between always running behind money and having money quietly work for you while you live your life. Thanks for watching. Please like if you found this helpful, leave a comment, be sure to subscribe, and share this video. You can find useful links in the video or channel description. See you soon.